market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, another packed show this morning. Voters across the U.S., from New York City to Virginia, preparing to cast ballots in the first real test of the political landscape since Donald Trump's return to the White House. We'll discuss that in a moment with, of course, Matt Winkler. But first, the markets being shaped by the AI play of the Fed. And here in the UK Chancellor Rachel Reeves has spoken over the last hour, reassuring the markets that she's committed to the government's fiscal rules. However, she also warned that tough decisions are coming ahead of her budget later this month.
Inflation is already much lower than the double digits seen under the previous government. And the choices I make in this budget this month will be focused on getting inflation falling and creating the conditions for interest rate cuts to support economic growth and improve the cost of living.
Well, with us now, Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan Asset Management, and Bloomberg's UK correspondent, Lizzie Burden. So there's a lot going on in the UK. Lizzie, what were the main key takeaways from what Rachel Reeves said?
Well, I just want to start by saying how unusual it is for the Chancellor to make a speech like this just weeks before the budget. She wasn't out with particular measures. She was laying the pitch for what we expect will be tax rises in the budget, making her arguments for fair tax rises, as she's characterised them, and suggesting that her measures perhaps will build more headroom than we've seen before, £9.9 billion, which, as we know, has led to so much speculation in the markets all the way to the next budget, next fiscal event of what will come next. So she set out the narrative of who to blame, and surprise, surprise, it was the Tories. She was talking about an ill-conceived Brexit, the pandemic, tariffs, the austerity as well. But what she didn't talk about was the inflationary impact of her last budget. She didn't talk about how her manifesto, Labour's manifesto, had pledged not to raise the three main levers of tax. That doesn't leave her many options. But a really key line, I thought, in what she said was about, she said, we were elected on a commitment to put country before party, the national interest before political calculation. So perhaps she's asking the nation here for permission to break the manifesto.
So what do we know about the tax reforms? I know a couple of think tanks have been going through it, saying, look, they could look at freezing income tax threshold, but also raising dividend tax.
Yes, exactly. But the way she's characterised this as fair tax rises suggests that she's going to try and target the very rich in society who perhaps would be leaving the UK. We already know that they've been targeting non-DOMs. And so there could be an exit tax and there could be a higher tax on the wealthiest homes in Britain. We're not exactly sure how that would work. As you suggest, the Resolution Foundation's been talking about maybe going for income tax, but also payroll tax at the same time to balance it out. We don't know what the measures are. This is very much what Reeves was saying today. I'm not going to tell you what I'm going to do yet, but the suggestion is that you are going to see more headroom, and therefore the market reaction was that yields were lower. The 30-year yield is lowest since April, right. But surprise, surprise, it reversed that through the speech. In fact, when it got to the Q&A portion, the pound, though, also the lowest since April during this.
Lizzie, thanks so much. Lizzie Burden, there, our UK correspondent. And when you look at a lot of the market reaction, but actually what the UK will do in the next couple of quarters, again, Rachel Reeves, is there a danger that there's going to be more of an exodus of wealth if more tax rises come in?
I think, to be completely honest, in line with what Lizzie said, we just don't know what's going to happen yet. We don't know what's in the budget. I don't think we actually really learnt a huge amount more this morning. I think basically what the Chancellor was looking at was saying that we are in a very challenging position. It does look like that parts of the manifesto may have to be broken on the tax side. Whether it's targeting the ultra-wealthy, that would obviously possibly lead to further exodus. But I think really what we do know is that they've learned from the last budget that they are in a tough position. What they can't do is they can't put policy through which is inflationary. I think that's the most important thing from my standards as I think about it as a sort of fixed income investor.
Yeah, and do you think that's actually their number one priority, that they're aware of that? Again, last time there was a pretty, narrow landing strip for the plane that didn't quite land. There's no good options, mate.
There isn't. They are in a very tough position at the moment. They've got a big fiscal hole. They need to fill that. The most efficient way to do that will be through tax rises. They're going to try to avoid inflation. They're wanting to work with the Bank of England. The Bank of England are obviously, at the moment, they're stifled by the fact that inflation is still well above their target. They are in a tough spot. And to me, it's just laying the groundwork for what's going to happen in a couple of weeks' time at the budget. And it does look like they're going to be looking at taxes.
Now, there's a lot going on, of course, with the Fed. And, I mean, what does it mean? Gilts, the budget will definitely move gilts. But what's your hunch right now? Like, do you have any targets?
So we're actually very constructive on the gilt market at the moment. And I think when I look at what is priced into the market, slightly surprised that there's not more for later this week. Right. But I think it really, how we think about it over the longer term, how much is priced over the next year or so. If we do get tax rises, if we do get policy that's going to be disruptive to growth, but at the same time isn't going to allow inflation to move high, or it's going to prevent inflation or hopefully prevent inflation from moving higher. And we did get constructive inflation numbers most recently. Maybe the Bank of England can do a little bit more. I think it's been very interesting today what later this week, as to what the split is from the Bank of England. But actually, when I look around the sort of the global bond market and what happened last week, which was maybe more of a hawkish tilt from some of the other central banks, I actually think the gilt market and the Bank of England could be quite constructive.
What's your take on Fed? Again, we're kind of in a dark period. I know that the markets, when we had the Fed last week, they didn't actually push back against what the Fed was saying, but there's still a government shutdown. We just don't have the data.
They don't. I mean, there is a lot of private sector data they're going to go through. We're obviously going to get ADP this week. But again, they're in a very tough spot. And I think it's just evidence from what Jerome Powell laid out in the press conference that they're a very divided committee at the moment. As we saw, there was a dissenter for more cuts. There was a dissenter for staying on hold. You've got I think, kind of right down the middle, decided in a sort of divided committee, and they're going to be in challenge there. And what they're really struggling with is the fact they're not getting the data coming through. Now, your expectation is that you are going to hopefully will have some form of resolution come the December meeting, but who knows? And I think the question that I've got now is, if we don't have a resolution and we don't get any more data, is this a Fed on hold because they just don't know what's going on? They've done 2 risk management cuts. I still think I would lean towards the fact that they go again in December. But I do think I would really like to start seeing some of that data come through. And I think a lot of that committee would like to see more confirmation that there is a continual slowing in the labour market. Yeah,
I mean, what's your take on actually tariffs in general? I know tomorrow is going to be the big Supreme Court ruling on whether some of the tariffs are legal or not. But it seems the markets, fixed income have moved away from that.
I think so, and I think ultimately if there is some sort of ruling, then maybe they'll find other ways to put tariffs on. I also think you need to take a step back and think how much revenue is now coming in from tariffs. That obviously goes to offset some of the spending from the One Big Beautiful Bill Act, which is going to be coming in next year. I think it's going to be very difficult to see tariffs come down, personally.
I know you don't talk about tech earnings, but actually because the market is so supported by tech and there is a little bit of concern over Palantir and actually whether these lofty valuations can continue at these levels, whether they're priced to perfection, is there a read across?
I think the way I look at it from our standpoint on the bond side is obviously we've had a lot of issuance coming out of the tech companies this year. And I think this week, last week or so. And I think that's probably caused some of the anxiety in markets. And I think it's very interesting. Last month, we actually saw credit spreads wider while the stock market was still up 2%. So there's definitely a bit of indigestion of the bond space. I still think that when I look at it, the amount of debt that's being issued, yes, it seems very large, it's just an outright number. But when you compare it to the market cap of some of these companies, and these companies are still making a lot of money. There's a lot of free cash flow going through the system. I do think there's a question of going forward, the amount of expenditure, the amount of capex that's going on in AI, but at the moment it's justified. And I think market pullbacks are healthy. We can't go up in a straight line forever.
Fair, very fair. Is there anything actually overall in the market across the world that you see as good value? I know a lot of the emerging markets also issued a lot of bonds in the last 6 to 7 months. Is there anything that you'd be scooping up right now?
I actually think the all-in yield argument is reasonably compelling if you're getting central banks that are still erring on the caution and pressure of easing policy in the future. I think that still looks pretty attractive, particularly in real terms. Where the real value is within the emerging markets. So if you look at some of those local emerging markets where you're seeing real yields of 5, 6, 7, even 9% in places like Brazil, I mean, that's very compelling. And if those central banks that feel that they have the ability to be easing policy from here, then you could get some significant capital gains there.
Iain, thank you so much. Iain Stealey, they're a Fixed Income International Chief Investment Officer at JPMorgan Asset Management. Now, don't miss our special coverage this Thursday also of the Bank of England rate decision. That's due at midday UK time with programming on Bloomberg TV from 12:15. We'll also bring you Governor Bailey's press conference a little bit later that hour. Now, Americans head to the polls today to decide the winners of gubernatorial, mayoral and legislative races, as well as judicial seats and ballot initiatives. Election Election Day marks the first real test of the political landscape since Donald Trump's return to the White House, offering an early glimpse of how his administration will oversee elections, whose integrity he and his allies have repeatedly challenged. On Truth Social last night, President Trump endorsed Andrew Cuomo for New York City mayor. The race to lead America's biggest city has drawn national attention as a proxy battle over urban governance, progressive politics, and, of course, the future of the Democratic Party. Both Cuomo and Zohran Mamdani, the frontrunner, have had a lot to say about Trump.
We need a mayor who can stand up to Donald Trump, who can get the funding that New York deserves, who can make sure the National Guard does not come to New York. I can stand up to Trump. Trump will go through Mamdani like a hot knife through butter.
Movement's embrace of Andrew Cuomo is reflective of Donald Trump's understanding that this would be the best mayor for him. Not the best mayor for New York City, not the best mayor for New Yorkers, but the best mayor for Donald Trump as his administration.
Well, joining us now to talk about the elections, Bloomberg's editor-in-chief emeritus, Matt Winkler. Matt, always good to speak to you. Second day in a row. It's our lucky strike. Are these elections really a proxy for voters in the U.S. on whether they're happy with the Trump policies?
Without a doubt. And you know that because the latest CNN poll shows that Trump's approval is actually the lowest since he left office after his first term. He was at 36%. The latest CNN poll says his approval is at 37%. His disapproval now is 63%, which is the highest ever. So that is a snapshot of perception. Now, what's behind it? The same thing that got him elected in the first place. Inflation is higher today in the U.S. coast to coast, north to south, east to west, than it was in Biden's last year. So costs are up. And then I haven't mentioned all the ICE intrusions in major metropolitan areas. You could say the murder of people in the high seas. All of that's in the background. The fact that just about everything that Trump has done since he got into office has been unconstitutional. All of that is going to play out tomorrow. And probably you're going to see a Democratic governor in New Jersey, a Democratic governor in Virginia, a Democratic mayor in New York City.
I mean, Matt, New York is really fascinating because the two candidates are so different, and it also speaks to, where the Democrats go from here. Well,
our profession has spent a lot of time talking about everything but New York City with Mamdani. Gaza really doesn't have much to do with running New York City. And what he has been about is two basic issues that are as relevant in New York as they're relevant in London: food and shelter. And he was the only mayoral candidate actually campaigning on those two issues, that the cost of food, the cost of shelter is too high in New York. And that's what has actually won him the support that probably will get him elected.
I mean, does Donald Trump, go after New York?
Donald Trump will go after anyone if he can, and that's been his practice. It remains to be seen, though, what he does when there's resistance. And as you're probably aware, the courts right now have been resisting just about everything Donald Trump has been doing. That's likely not going to end anytime soon. So even if he tries to hurt New York, there will be litigation that gets in the way, just as it has in Chicago and Los Angeles and Portland, Oregon, and so forth.
Okay, Matt, thank you so much. We'll have to also see, the way this pans out and whether they're fair and free elections. A disclaimer: Michael Bloomberg, founder and majority owner of Bloomberg LP, the parent company of Bloomberg News, has endorsed Andrew Cuomo's mayoral campaign. Our editor-in-chief emeritus, Matt Winkler. Coming up, we'll be looking at how shifting monetary policy is also changing the way private equity firms approach deal-making and finance with our next guest. Our conversation with the co-head of EMEA investment banking at Goldman Sachs. That's next, and this is Bloomberg.
Given that we are likely moving in the right direction, I thought a 25 basis point cut was appropriate. But again, December is a live meeting, and I'm attentive to all the indicators that I mentioned and many others. So it's a balancing act, and it always is.
Well, that was the Federal Reserve Governor Lisa Cook. Now let's discuss the Fed path and what it means for private equity and deal making with Anna Skoglund, co-head of the EMEA Investment Banking and of the EMEA Financial and Strategic Investors Group at Goldman Sachs. And I'm so happy to have you in the studio because there's a lot to talk about. In general, I mean, look, if you look at the Fed rate path, is it really shifting the perception? You know, is the monetary policy changing the way that private equity firms approach deal making, but also financing?
Well, thank you for having me. I'm delighted to be here. Listen, I would say that throughout 2025, we've seen an increasingly supportive environment anyway. So, you know, we've seen M&A volumes up 40%. We've seen sponsor activity coming back in earnest. And we're seeing people being quite forward-leaning anyway. So, of course, a rate cut will be supportive, further supportive of that. But I don't necessarily think it's going to fundamentally change the momentum we're seeing. If anything, it's going to continue to 26 and 27.
Are you seeing, you know, some of the sponsors lean more into syndicated loans, right, rather than private credit these days?
Yeah, I wouldn't necessarily say more into. I would say the private equity sponsors will take whatever financing solution suits their needs, suits the specific situation. You know, private credit is here to stay. I think it's a very flexible and attractive solution. But also syndicated loans might be the appropriate situation depending on the situation. So I think we'll see both.
Yeah. And where are we on private credit? Are we just going to see bumps along the road? I mean, there was a couple of, there were a couple of days, like 10 days ago, where people were really worried about what it meant for the future.
Yeah, I would say that the private credit market is a big, deep, and sophisticated market at this stage. You know, at Goldman Sachs, we've had a private lending business for more than 30 years. The underwriting standards are solid. I think people have, an ability to really assess risk in the appropriate way. So I think it is the natural sort of developments when a market, enters into some form of acceleration in activity, but I wouldn't necessarily say that there's any reasons to worry.
Has anything changed actually in your space in the last 12 to 14 months? I know we try and figure out whether, for example, there's more time on credit and secondaries after Carlyle reported earnings last week, and again we saw this slump in private equity, but the firm's credit and secondary was doing really good. Does that change the way you service them?
What I would say, if you take a step back and think about the expansion of the broader alternative asset management industry, from the end of the financial crisis leading up to 2022, there was a significant expansion driven by a shift from public to private. But also, I would say the velocity of money was accelerating throughout that time, driven by falling interest rates, quantitative easing in connection with COVID, etc. That expansion came to quite an abrupt end, beginning of 2022, and we've seen 2-3 years of unwind. I would say today we're on a solid footing to look forward into, and that's why we're seeing some of this accelerating activity coming from a solid and healthy base. So, secondaries, different, continuation vehicles, IPOs, sale to strategic, all these various things are contributing to what I would see, this acceleration in activity. Secondary is the liquidity function of private equity. So that's what that is. And I also think it's a hallmark of a more sophisticated, mature industry.
Where do you see the most important deals? Or where are your clients looking at? Is it regionally or is it really industry-based?
What I'm really encouraged by, it's broad-based. Okay. You're really looking at a business today, which is, we have activity in the US, obviously, but we also have activity in Europe, in Asia, in the Middle East. So that's from a regional perspective. We're also seeing activity, in TMT, in infrastructure, in services, etc. The difference between 21 and today is that the activity is much more broad-based and therefore, I would say, more sustainable in a way. So that's exciting.
Is that surprising? I mean, again, there seems to be much more uncertainty out there, right? And so there were a lot of questions on whether a lot of the deals would be made in the future. But does this uncertainty, have people worked around the uncertainty? So is this like the new normal, or is it just cycles?
Yeah, I think people have gotten used to gotten used to. What I would say is they've factored that into their decision making. And one of the things you mentioned, I just want to pick up on, in terms of we saw less secondaries, i.e. private equity buying from private equity. That has come back this year. And actually more than a third of entries in Europe from private equity has been from another private equity sponsor. But I would say back to your point about uncertainty, I think it is part of the decision making. And you saw that actually throughout this year, where you've had more volatility than we've had in a long time, and actually people adapted pretty quickly to that.
And I mean, last month we saw JPMorgan agree to put up the full debt commitment for the $55 billion take private of Electronics Arts. There's probably no other firm that can do that in terms of that amount. What do you think it says between the push and pull in the battle between direct lenders and traditional Wall Street?
I go back to the point that I made. It depends on the situation, and it depends on what does the company need, relative cost and sort of structural benefits, etc. So I don't think it's either or. I think it's and. What
are you most excited about in the next 12 months?
2026. I'm excited about 2026. Exactly. Listen, I'm excited about the fact that our franchise today, I would say, is the strongest it has ever been, based on a few things. One, our absolute and relative performance. Two, the broad-based feature that I mentioned in terms of between M&A, equity, financing, but also some of our asset-backed financing businesses. We created CSG beginning of this year, and it's working. If anything, I think origination is going to be a strong competitive advantage for us, and we're excited about that. And then I would say, we are continuing to see activity from all bases, from all regions or sectors, etc. So that is, I'm excited to take the team on the field, so to speak.
That's work more. What does it mean for jobs? Are you hiring?
We're hiring. We're always in the market for the right talent. And, if anything, I would say, there's a lot of talk about AI and what that's going to do to our industry and every industry. What I would say is, I think talent, there's also always a bid for talent, and we're always in the market for talent.
How much are you actually deploying AI, or how much time are you thinking about how to deploy AI in the right way?
We're spending a lot of time on it. And, we announced, when we announced our results, we announced this OneGS 3.0. A lot of that is based on the opportunities that AI provides. And I would say, the interesting thing, people are a lot focused on things like headcount, et cetera. I actually would turn it around. If I think back to what I was spending my time on as an analyst starting at Goldman Sachs in 1996, that was quite a lot of manual tasks, took a lot of time. You had to go to the library, pick up the annual report. Today, that's done, very quickly. I would say this is an opportunity for all our people to spend time on more high added value tasks.
I love that. Anna, thank you so much. Anna Skoglund there, EMEA co-head of investment banking at Goldman Sachs. Up next, we're joined by Bob Diamond. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The UK Chancellor, Rachel Reeves, says she's committed to her fiscal rules, but declines to reiterate her election promises on tax in a speech 3 weeks before her autumn budget. Stocks retreat as AI bellwether Palantir fails to impress, and Wall Street bosses warn of a possible correction to lofty valuations. Plus, President Trump endorses Andrew Cuomo, threatening to withhold federal funding if Zohran Mamdani wins today's election for New York City mayor. Now, the Goldman Sachs chair and chief executive says the M&A backdrop is looking constructive heading into 2026. The comments came as U.S. deal-making is ramping up in the final months of the year, where David Solomon spoke exclusively with Bloomberg TV in Hong Kong.
So the U.S. is a huge part of the global M&A market, either for target or acquire.
Right.
I would say it's extremely constructive, and we see it, in our advisory business. You can take a look at our M&A revenues last quarter, which are a reflection of deals closing. But if you also go through our earnings call, we made a comment about the level of our M&A backlog,
yes.
The very high level of our M&A backlog. Yeah. And that's just an indication of the fact that there's a lot of activity inside the firm. I'd say this is really rooted from the fact that we went through a period for 4 years during the Biden administration where if you wanted to do something strategically, if you wanted to do something significant from an M&A perspective, whatever the question was, the answer was no. We're now in an environment where whatever the question is, the answer is maybe. And I think CEOs are unleashed in believing that they have a chance of doing strategic things to advance their position, to advance their scale, to advance, how they sit competitively. And so we see a tremendous backlog of significant consolidating situations, what I'll call large cap M&A. Large cap M&A in the United States is up very, very meaningfully. Deals over $10 billion, very, very meaningfully year over year. And so I think we're in a pretty constructive environment. And my expectation is 26 and 27 will be quite constructive in terms of large cap M&A, particularly in the United States.
That was the Goldman Sachs Chair and Chief Executive Officer David Solomon speaking to us exclusively. Now let's discuss deal making, the deal making environment, what it means for private markets with the former Barclays Chief Executive Bob Diamond. He's also, of course, a founding partner and Chief Executive of Atlas Merchant Capital, a specialist private investor in financial services in the U.S. and Europe. The firm has acquired the banking advisory firm Panmure Liberum and the broker-dealer Kepler Cheuvreux, amongst others. Bob, thank you so much for joining us. You've been busy. I mean, you've been acquiring. Are you still on the hunt? How much do you want to grow?
We're still on the hunt. I think very pleasing for us is we've had a great year in realizations. We had an investment from very early on, 2001 in Circle. And of course, they did their IPO this year. And then another fantastic company, Marshberry, which is a middle market M&A insurance focused, just with an incredible team. And one of those transactions, Francine, where we're happy, the management team's happy, Lincoln International, who's the acquirer, is happy. Everyone's happy.
Happy days.
Exactly.
What's less happy is maybe some of the concerns about private credit. So, investors were certainly quite jittery after some of the most recent earnings from some of the banks because they were trying to understand how much they were stung by the high-profile bankruptcies of First Brands and Tricolor. Do you think this could happen again?
Listen, I think these are single-name kind of episodes. I think the whole move toward private credit in the wake of the financial crisis has been very positive. I mean, you and I have talked about this before. One of the great things about, the U.S. economy is they have this huge financial services industry, very diverse, private equity, hedge funds, venture capital, private equity, so many sources of financing. I think that's been a very, very positive thrust. And I think what we're seeing right now is more single-name episodes, but I see nothing systemic in what's going on. Do we expect there to be more cracks in credit? I think we've all expected it. It's been a long bull run in credit. We had that long period of time of zero interest rates and probably less covenants. But there's nothing systemic going on that we see. We do expect there to see more cracks.
Is there anywhere that you would look for in particular? Or is there, if you say there's no, it's not systemic, but could there be a broader reason to worry?
I think there's actually quite a bit of money sitting on the sideline looking for opportunities to invest in credit. I think these are very special situations that we've seen. I don't think they're indicative of what's going on in the credit space. But I think seeing some crack. We still have very, very tight spreads, really, across the whole credit curve. So I don't see anything that causes me concern from a systemic point of view.
The other thing we're trying to figure out was this, jolt when it was revealed that BlackRock's HPS has written off about $150 million in exposure to a group of companies, to zero. Is this targeted, or is there something about lending standards?
I worry about a lot of things. HPS is not one of the things I worry about. They've been a juggernaut, and I think them running off a few things is, again, we will see some cracks in credit, but not systemic.
So what do you worry about?
I'm feeling pretty good about things right now. I think, you had the clip from David Solomon as we're starting. Deal making is alive and well, and some of the tailwinds coming from the U.S. and from this administration, from the Secretary of the Treasury, from the Chairman of the SEC. What a sea change from kind of the era of Gary Gensler and that malign neglect at the SEC where they would approve nothing. And now, whether it's the attitude toward regulation, where the attitude of the Treasury and the attitude of the SEC toward regulation and financial services is not to ignore digital assets. It's actually to integrate regulation across both traditional finance and digital assets. And we've seen such a change in the last 6 or 9 months with BlackRock doing ETFs in Bitcoin, Larry Fink talking about the tokenization of assets across all of BlackRock. We're seeing real institutional adoption, and we've recently done a transaction where we're working with Hyperliquid, the exchange in Singapore, and built on a blockchain that is incredible. And I think Bill Winters made the comment yesterday in one of the interviews here about blockchain being the underlying technology of finance. We think of Hyperliquid as the exchange of the future. So I'm rambling on. There's so much going on in the digital asset space, so much going on in traditional finance, and the tailwinds in terms of consolidation, in terms of more simple, straightforward regulation of financial services, is powerful.
But so how does it change your business into what you want to get into? Will it change it significantly in the next 4 to 5 years?
So I think the biggest change, Francine, is that we're seeing a integration of the best of digital assets. We first really we got involved in this with Circle in 2021, as I'd mentioned. We learned a lot about the blockchain. We learned a lot about stablecoins. We are seeing with the success of Circle and USDC, just those types of things. We're now learning a lot about how the blockchain with the decentralized exchange and Hyperliquid can really begin creating an opportunity. Hyperliquid has begun trading not just HYPE, its token, but is now trading NASDAQ futures. So the integration of a lot of things in traditional finance with the best of digital assets, starting with the blockchain, I think is creating a tremendous opportunity.
Does Europe get left behind?
Well, I think in terms of the tailwinds that I mentioned, wouldn't it be wonderful to see banking union? Wouldn't it be wonderful to see cross-border integration? You know, we've seen many opportunities for the governments in Europe to approve cross-border transactions, which we think could have been very, very beneficial. The attitude of this administration in the U.S. to consolidation, regional and community banks is a good example, and the recent transactions that we've seen has been very positive. I think if Europe had the tailwinds of more positive cultural attitude to cross-border consolidation, more of an attitude toward bank capital should be simpler, maybe stay where it is or go a little bit lower. I think the outlook for financial services across Europe, it's better today. You know, you got banks like Santander and Standard & Chartered really performing well, but I think there's a lot more here.
But you've said in the past that actually one of the biggest opportunities is banking in the U.S. because of M&A and bank consolidation. And we're just seeing the green shoots of that. So how are you going to, I guess, capitalize on this trend? And, I mean, could you see big tie-ups between banks, or how do you see that space evolving? I
wouldn't say big tie-ups. What we are seeing, and we're very focused on regional and community banks. So we've done a first close in a fund 100% focused on consolidation in the U.S. banking industry. Today we have 4,500 banks. When you mention that to people that don't know, they go, 4,500 banks in the United States? That's the wrong number. Well, it is the wrong number, and many of the smaller community banks are too small to succeed to get their return on equities back above 10%, up to something more credible for their valuation. And the ability to do in-state mergers, and with the support of the Treasury and the SEC in terms of approvals of these in the OCC, we think that there's going to be consolidation that takes that number of 4,500 to something closer to 1,000 or 1,500 literally over the next 2 to 3 years.
Do you have, sorry.
No, go ahead.
Do you have ideal tie-ups?
We have absolutely ideal tie-ups. We're working on them right now, and we can't say a thing about them.
Give me a flavor of what what you think will happen, if not what you're looking at.
So one of the best opportunities is for banks, say, in that 10 to 50 billion area. Higher regulatory capital hits in at 100 billion. Most of the banks want to either stay below that or have a clear strategy approved by the regulators before they go over that. But there's tremendous opportunities for banks in that 10 to 50 billion area to acquire, smaller community banks, typically more private, often in state, where you think about the costs of technology come right out, because almost all of these banks are on the same technology platform. the costs of regulatory relations. You've got duplicate departments that comes right out. So what we're seeing, Francine, is a opportunity to get really, really good returns just from the cost synergies, to say nothing about the revenue synergies. And if you can do them in state or close to state, those revenue synergies come even more quickly.
Well, thank you so much. So we'll see you back when there's a deal, maybe on the horizon. Bob Diamond there, Chief Executive of Atlas Merchant Capital and former Chief Executive of Barclays. Now let's bring you a redhead. This is breaking news just crossing the Bloomberg terminal. European leaders, actually including the German Chancellor Friedrich Merz and the European Commission President Ursula von der Leyen, will skip the EU summit with Latin America and Caribbean states. And this, we understand through our Bloomberg reporting, is due in part to concerns over angering the U.S. President Donald Trump. Now, the European Union CELAC summit is coming under scrutiny in Europe as the U.S. targets countries, including Colombia, which is hosting the summit, and Venezuela over drug trafficking claims. This is according to our reporting and according to people familiar with the matter. Now, we've been talking all day about AI, and the AI play is again shaping market sentiment as Palantir shares fall despite raising its annual revenue outlook. Our Peter Elstrom, Bloomberg's executive editor for Global Tech, joins us now. Peter, thank you so much for being here. So analysts broadly positive on third quarter sales, but actually they really worry about valuations. Like, what's happened today that didn't happen last week?
Yeah, Palantir reported earnings that, first of all, it's worth saying were very, very strong. This is a company that's beat earnings estimates for 20 quarters in a row. It did it again. Their revenue projection was supposed to come in at $1.18 billion. Sorry, the revenue projection was supposed to be 1.09, and they came in at 1.18, grew 63%. They also beat on earnings. They beat in the forecast for the current quarter. There were some expectations that maybe they would talk about 2026. They didn't do that, actually, so maybe that was a little bit of a disappointment. But Alex Karp, the outspoken CEO of the company, said this is not just a strong quarter, this is maybe the strongest quarter that any software company has ever reported before. So you hear his exuberance about how they're using AI to help governments and corporations make better decisions with the data that they've got. But as you alluded to, valuations are very, very high. Palantir is the highest valued company in the S&P 500. It's trading at 85 times sales right now, and there are concerns about that valuation. The shares are up about 175% just this year, 400% over the past 12 months. So those valuations are really coming into concern right now. We also got reports overnight that Michael Burry of Big Short fame is shorting Palantir and NVIDIA. So he's one of the people who are coming into the argument about whether there's an AI bubble or not, saying perhaps there is a bubble here.
What's next, Peter, on the agenda for Palantir, and how are their shares likely to fare in the coming months?
Well, again, Alex Karp, the CEO, has been talking about how their business is rolling out. He said they're growing very, very quickly at this point. 63% this quarter for the top line is very fast. Their software is used by the military, of course, governments, and also corporations, so that they can collect a bunch of information that used to be scattered throughout the organization and make better decisions. That maybe is on the battlefield, where you need commanders who can make more logical decisions about how they're going to deploy troops. It could be in government, where you're trying to make more logical decisions about how you allocate your resources. And for corporations in particular, it's very important to be able to get this scattered data throughout the organization, consolidate it so that leaders can make more logical decisions. He says that business is exploding at this point. Again, he didn't talk about 2026 in particular, but they did talk about strong growth throughout the end of this year.
Peter, thank you so much. As always, Peter Elstrom, Bloomberg's executive editor for Global Tech. Now, coming up, signs that BP's turnaround is gaining traction. We'll get more on the oil majors' earnings next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, BP profit has exceeded expectations with operational improvements and higher oil and gas production outweighing lower prices. Now, the chief executive, Murray Auchincloss, told us earlier that the company is growing volumes.
The operations themselves were running very well. In the downstream, we've had our highest refining availability in 25 years, and our customers' business had the best result in history. And then on the upstream, of course, we're growing volumes 2 to 3% per year, and we've had 6 major projects come online, 4 ahead of schedule.
For more on this, we're joined by Bloomberg's Alex Longley. Alex, so good to speak to you. So what were your main takeaways from what we heard from BP?
I think we're hearing a lot in the analyst notes this morning as well. This is sort of the turnaround starting to gain some momentum. I think in the last quarter, we sort of saw the story really begin to sort of shift for BP away from being kind of the least appreciated of Europe's oil majors, and now it's kind of more on an upswing. And I think BP is kind of the last of the European oil majors to report as well, has kind of followed through on a lot of what the others have said. It's kind of delivering operationally, tightening its belt as best it can in the current price environment, and that's kind of helping also contribute towards that turnaround.
So, Alex, what do you make of the U.S. shale asset divestments?
I think one of the interesting things there, compared to what we've seen in some of BP's other divestments, is that they're going to retain that kind of operating stake there. Clearly, what we heard from the CEO on TV this morning as well was saying, really, they're looking to divest things that aren't core parts of their business. And again, that comes back to how can big oil best operate in this price environment? And really, that's being as integrated as they can, having refining and trading and upstream and downstream operations that are all fully integrated. And so I think perhaps the interesting nugget in the US shale divestment there is actually that's one thing that they're still kind of clinging on to in terms of operating. I mean, how different, because we know that the two CEOs are very different, but how different are they from a Shell? I mean, there are overlaps. Clearly, they took different paths in the past, and that is the big difference, right? I think in terms of how investors are looking at them, I think it would be fair to say people are just focused on BP and that turnaround and kind of how they can best operate in this environment. But clearly people always compare them against one another, as well as kind of two darlings of pension funds here as well.
Alex, I know this is going to be a difficult question, but how far along are we in this turnaround of BP? Is it impossible to say, given all of the variables?
I think so, given the amount of divestment still to come as well. I think they've talked about their targets, and they're sort of tens of or up to sort of $20 billion of divestments, and a long way still to go on that. I think, again, when Murray talked about Castrol this morning and the potential to transact there, I think you're kind of waiting to see what some of these figures come up at to then see where this turnaround ends at. But from the numbers they've put up so far, there's clearly been significant progress made, and I think they kind of talked about that multi-year program, and we're kind of at the starting point of that, but there's still a good couple of years to run on it.
Alex, thank you so much. Alex Longley there with the very latest on BP. Now, the EU racing to approve a climate target ahead of COP30 summit in Brazil. Ministers are meeting in Brussels to hash out a deal on the emissions cuts they expect to deliver over the next 15 years. Well, joining us now from Rio de Janeiro is Bloomberg's David Gura. David, it's a tough gig, but somebody has to do it. Will the EU ministers agree on a climate deal in time, and what's at stake?
Yeah, so this is, I look at this in two ways. The first is what's possible. What can these member states agree to? And you don't need you just need a qualified majority here. Everyone doesn't have to agree. And so the threshold that the EU is looking at here, 90% reductions here over the next 15 years up through 2040. And it doesn't sound like there'll be unanimity in any sense of that here. So that's like what's being haggled out in Brussels right now. That, of course, is the issue of what the EU has to do at this moment in time when the terrain has shifted so much, as you know. And the EU has a chance here. Europeans have a chance here to present a real leadership role to the world because the United States has stepped back. And I should point out sort of where we are in this process. Yes, I'm in Rio. There are folks in Sao Paulo at this point. The focus shifts to Belém here in a couple of days, that city on the Amazon River, and that's where the leaders are going to gather here. And it's funny, the trajectory of this is different than in COP30's past. That usually kind of is the culmination of this process, this 3-week-long process that's happening in the middle here. So time is short, Francine, for Europe to do this, for other countries to do that as they come here. And I should say there are kind of muted expectations for what's going to come out of this conference. Again, participation is lower than in years past, and there is this X factor looming large over this entire conference of the United States, not just taking a step back, but kind of rejecting the premise of climate change overall. What does that mean for this conversation broadly? It's certainly casting a large shadow over the conversations taking place here in Rio, in Sao Paulo, and surely what will take place in Belém as well.
There's also a glaring absence from the summit, which is the U.S. How will this impact what can actually be achieved?
Absolutely. And I think, everyone here is dealing with what were seismic words from President Trump at the UN General Assembly. You heard them in real time, as I did as well. And, there are things that President Trump says over and over again about climate change. When he went into the UN General Assembly and said that climate change was a scam, I think it really startled a lot of people because it marked such a stark change from what we'd heard from past administrations, even a stark change from what he said during his first term. There was a level of engagement here by the U.S. that we'd had during the first term of President Trump. That has changed. As Bloomberg has reported, we're not going to have anybody from the White House, any senior officials coming down here for this conference. It really does bring into question what you just brought up, which is what is achievable here in the near term. We're talking about this 15-year horizon, and you talk to scientists and climate experts, of course, and they say even that 90% reduction in Europe, reductions that other countries and nations are talking about, may not be sufficient in the long term. So it's kind of recalibrating and trying to figure out here what's necessary, indeed, what's going to be achievable here in the years to come.
David, thank you so much. David Gura, of course, with our outstanding reporting overall. I mean, David, when you look at the landscape, what have we heard so far?
So here in Rio, you have a lot of mayors and governors from the U.S. and around the world who are gathered here and kind of thinking about how they pick up the mantle, how they fill that void that we've been talking about here. If you don't have the United States playing as active a role as it played in the past, if you don't have nations able to come to agreement in this world that seems so fractured, what can they do at a local level? And so they kind of think that they can be a test case for what other cities, what other states can do, what can be emulated, and also perhaps what nations can adopt here going forward. So that's very much the conversation that's taking place here. And I should just point out, this is all happening in this crucible of a real reorientation of the global terrain. The last time that I was here was for the G20 at the end of President Biden's term, and you could see almost in real time playing out here on the ground in Rio, sort of the fragmentation and changing of the global dynamics among these many nations. That's certainly the backdrop to the conversations taking place here as well. Who's in a leadership role? Who's able to do more? The U.S. isn't going to be here. I should say the Chinese leadership isn't going to be here as well. So what does that mean going forward? It's very much the open question people are dealing with. It's all the while, Francine, they're trying to figure out sort of what can be done at the subnational level, the level below federal governments, national governments, to try to figure out how to tackle climate change.
Yeah, I'm really intrigued, David. Is the mood a little bit different to other COPs? I keep on hearing that a lot of the companies are still going ahead with their plans, but they don't want to talk about it too much because they don't want to upset the Trump administration.
I saw that news about the summit that's going to be scheduled in Latin America soon and how many countries aren't participating as a result of upsetting President Trump. I think that's very much in the backdrop here. But candidly, having been at the conference yesterday and talked to mayors and governors here, there are many who say they have to move forward without thinking about that they can't kind of go about their jobs wondering what the Trump administration is going to do. And I spoke yesterday with the governors of New Mexico and Wisconsin. Both of them are very progressive when it comes to climate change and have worked in those two states respectively on developing climate legislation that they plan to enforce at the state level. They are very much speaking as though this is a moment for action. That, again, yes, it's a shame as they see it that the federal government, that Washington isn't doing more here, but they see the states as having an opportunity, and that's very much the mantle that they want to pick up, Francine.
David, thanks so much. I'm looking forward to your reporting all week. David Gura there on the ground in Rio. A reminder of Bloomberg's special coverage of the New York City mayoral election and the gubernatorial races in New Jersey and Virginia. That's from 5 p.m. Eastern, 10 p.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.